Nvidia's latest earnings report revealed a substantial 55.6% increase in second quarter sales, reaching $46.74 billion, up from $30.04 billion the previous year. Despite these impressive figures, Nvidia's stock did not see a rally post-earnings, partly due to the lack of H20 chip sales to China, which had been previously anticipated. The company did, however, benefit from a $180 million release of previously reserved inventory related to unrestricted H20 sales outside China. Nvidia's market capitalization is now so significant that it surpasses the entire stock market capitalizations of Britain, France, and Germany combined, highlighting its dominance in the AI chip market. This dominance is driven by the increasing demand for AI applications in data centers globally. In parallel, Palantir Technologies is gaining attention for its AI implementations, especially within U.S. federal agencies like the Defense Department and the CIA. Despite facing short seller interest, Palantir's stock is poised for a potential rebound, supported by a 21.4% upward revision in analyst consensus earnings estimates over the past month. This trend suggests a possible earnings surprise in the near future. The broader market context shows a strong focus on AI's role in productivity and economic growth, with AI technologies expected to further integrate into everyday life, enhancing industries such as warehousing and manufacturing. These advancements are anticipated to contribute to GDP growth while mitigating inflationary pressures.
The recent election of Donald Trump as U.S. president has heightened concerns over global trade and economic stability, particularly with the potential implementation of significant tariffs on imports from China and other countries. Trump's proposed tariffs, 60% on Chinese goods and 10 to 20% on goods from other nations, pose a substantial risk to global trade dynamics. These measures could severely impact industries reliant on Chinese imports, potentially leading to increased costs for U.S. consumers, especially in middle and low-income brackets. Krungsri Research estimates that such tariffs could curtail U.S. GDP growth by 0.97%. While these policies aim to boost American industries, they could also provoke retaliatory actions, further straining international trade relations and affecting global markets. In the Eurozone, economic challenges persist despite a slight improvement in the manufacturing PMI, which rose to 46 in October. However, the region remains in contraction, with the services sector also showing signs of weakening. The European Central Bank, ECB, is expected to continue its rate cuts to stimulate growth, projecting a reduction to 3.00% by the end of 2024. The Eurozone's recovery efforts are hindered by sluggish credit growth and a weakening labor market, with potential repercussions from U.S. trade policies adding to the uncertainty. The anticipated decline in EU exports, projected at minus 1.66% from the baseline, underscores the vulnerability of export-reliant economies to global trade tensions. China is also bracing for the impact of potential U.S. tariffs, with its export growth showing a paradoxical rise amid shrinking new orders. The anticipated tariffs could result in a 5.8% drop in Chinese exports from the baseline, with significant impacts on key industries such as electronics, rubber, and textiles. These developments highlight the intricate interdependencies of global trade and the potential for significant economic disruptions. As inflationary pressures and trade uncertainties loom, central banks and governments worldwide are navigating a complex landscape to maintain economic stability and growth.
The Trump administration's acquisition of a 10% stake in Intel for $5.7 billion marks a significant intervention in the semiconductor industry, aiming to bolster domestic chip manufacturing amid global competition. This strategic investment, sourced from funds initially allocated under the 2022 CHIPS Act, underscores the administration's commitment to revitalizing U.S. manufacturing and enhancing technological competitiveness against rivals like China. Despite the investment, Intel's CFO, David Zinsner, has reassured stakeholders that the company's manufacturing operations are unlikely to fall under external control, even as the government holds a 5-year warrant for an additional 5% stake should Intel's manufacturing ownership dip below 51%. The deal occurs as Intel faces mounting pressure from industry competitors such as Nvidia, which continues to dominate the chip market, particularly in AI technology. Nvidia's recent robust earnings report highlights its leading position, with significant AI infrastructure investments projected to reach trillions by the decade's end. Intel's strategic focus on its foundry business, including potential outside investments and the development of its next-generation 14A manufacturing process, remains crucial for its future competitiveness. However, the details of the government's stake acquisition are still being finalized, as indicated by White House Press Secretary Caroline Leavitt, reflecting ongoing deliberations within the Department of Commerce.
In a significant financial maneuver, major U.S. corporations including Apple Inc., Alphabet Inc., and Nvidia Corp. have collectively announced stock buybacks totaling nearly $430 billion in 2025. This move represents a substantial deployment of financial resources, marking the largest collective buyback effort to date. Stock buybacks, or repurchases, occur when a company buys back its own shares from the marketplace, reducing the number of outstanding shares and often boosting the stock price. While this strategy is applauded by shareholders due to the immediate financial benefits, it also raises questions regarding the company's long-term growth strategies and innovation pipelines. The financial sector has also joined this buyback surge, with Wall Street's largest banks, including J.P. Morgan Chase & Company, Goldman Sachs Group Inc., Wells Fargo & Company, and Bank of America Corp., each announcing significant buyback plans. Visa Inc. also made a notable contribution to the buyback tally. Despite the sheer scale of these buybacks, market reactions have been varied. Alphabet's buyback announcement significantly boosted its stock, while Apple's and Nvidia's saw more muted responses. This divergence highlights investor uncertainty about whether these buybacks signal robust confidence in future earnings or serve as a temporary fix to mask potential stagnation in innovation and growth. As corporate America continues this buyback trend, investors are left to ponder the sustainability of such financial strategies in the face of evolving market dynamics.
Canada's major banks, including CIBC, BMO Financial Group, TD Bank Group, Scotiabank, Royal Bank of Canada, and National Bank, have reported strong third-quarter earnings surpassing analyst expectations despite ongoing geopolitical and trade uncertainties. These banks have demonstrated resilience in a challenging economic environment, with CIBC reporting a profit of $2.1 billion and BMO experiencing a 25% increase in net income to $2.33 billion. TD Bank reversed a previous loss to post a $3.3 billion profit, while Scotiabank and Royal Bank of Canada saw profit increases of 32% and 20% respectively. National Bank's profits slightly increased to $1.07 billion. Despite these robust performances, bank executives have adopted a cautious yet optimistic outlook, acknowledging potential headwinds from global trade tensions and uncertainties surrounding the Canada-US-Mexico Agreement, CUSMA. CIBC's outgoing CEO, Victor Dodig, and TD's CEO, Raymond Chun, emphasized the potential for slower economic growth and inflationary pressures due to trade tensions. Although declining interest rates and supportive fiscal policies might offer some economic relief, the banks are preparing for potential economic volatility, maintaining elevated provisions for credit losses to manage risks. Overall, the banks remain committed to their strategic goals and client support, positioning themselves for continued strength amid geopolitical and economic challenges. National Bank's CEO expressed optimism about government-led initiatives to boost economic resilience through infrastructure investments, reflecting a broader cautious optimism among the banks as they navigate the fluid global trade landscape.
The Trump administration's decision to impose new tariffs has sparked significant political and economic debate, particularly among Republicans who find themselves in an awkward position. These tariffs, which are effectively taxes on imported goods, have led to increased costs for American businesses and consumers. The administration's narrative suggests that the tariffs are a source of increased government revenue, implying that foreign entities are bearing the cost. However, the reality is more complex, with domestic companies often absorbing these costs and passing them on to consumers, contributing to inflationary pressures. According to the Yale Budget Lab, the average American household is expected to incur an additional $2,400 in tariff-related expenses this year. The tariffs have led to broader economic repercussions, including disrupted supply chains and decreased investment. Major American companies like John Deere and Ford are experiencing declining sales and profits, partly attributed to these tariffs. Despite the negative public sentiment, as evidenced by a Pew Research Center poll showing majority disapproval, many Republicans have refrained from criticizing the president's tariff strategy. This hesitance is partly due to the belief among some constituents that foreign countries are shouldering the tariff costs, a narrative the administration continues to promote. However, as inflation rises and economic dissatisfaction grows, the political viability of this stance is increasingly questioned, leaving Republican politicians in a challenging position as they navigate their support for the administration's policies amidst mounting public discontent.
The recent legal battle initiated by Federal Reserve Governor Lisa Cook against the Trump administration marks a significant moment in the history of the Federal Reserve's political independence. Cook is challenging the unprecedented move by former President Donald Trump to terminate her position over allegations of mortgage fraud predating her appointment. This lawsuit could potentially reshape the established norms regarding the political independence of the Federal Reserve, which has historically operated without direct presidential interference. The outcome of this legal battle may set a precedent for future interactions between the executive branch and independent federal agencies, impacting market perceptions of the Fed's autonomy. In the corporate sector, Tesla continues to face challenges in the European market as its sales plummet for the seventh consecutive month. The European Automobile Manufacturers Association reported a 40% decline in Tesla's sales in July, attributed to CEO Elon Musk's controversial political alignments earlier this year. This decline comes amidst a broader surge in electric vehicle sales across the continent, with competitors like Chinese automaker BYD gaining market share. Tesla's strategy to introduce more affordable models may be a crucial move to regain consumer trust and market position in Europe. The company's performance in this key market will be closely watched by investors and could influence Tesla's global strategy and stock performance.
Avita Medical, Inc. is currently under investigation by the Portnoy law firm for potential securities fraud following recent financial disclosures. The investigation was prompted by Avita's announcement that a backlog in unpaid provider claims for its Racel wound care product adversely affected its financial performance in the first half of 2025. Specifically, the company attributed the backlog to contractors assigned by the Centers for Medicare and Medicaid Services, who either failed to assign appropriate pricing or adjudicate claims in a timely manner. This delay resulted in a significant accumulation of unpaid and underpaid claims, reducing the utilization of Racel and impacting Avita's revenue. The financial impact of these operational challenges was evident when Avita's share price plummeted by approximately 21%, from $5.38 to $4.25, following the announcement on August 7, 2025. This decline reflects investor concerns over the company's revenue prospects and the potential long-term impact of the backlog on its financial health. The Portnoy law firm is offering legal support to investors who suffered losses, potentially leading to a class action lawsuit. This situation underscores the importance of efficient claim management and transparent communication with investors, as operational inefficiencies can significantly affect market confidence and company valuation.
Gold prices experienced an uptick on Thursday as traders anticipated a statement from U.S. President Donald Trump regarding the recent escalation between Russia and Ukraine. After an initial dip, Brent crude futures rose by 0.8% to $68.62 per barrel, and West Texas Intermediate crude futures increased by 0.7% to $64.60 per barrel. The market's recovery followed the White House's announcement that President Trump was displeased with Russia's missile and drone strikes on Ukraine, which resulted in significant casualties. This geopolitical tension has injected volatility into the oil markets as traders assess the potential for further disruptions in global oil supply. The situation is further complicated by the interplay of other market factors. The Organization of the Petroleum Exporting Countries and its allies, OPEC+, are set to increase oil production by 547,000 barrels per day in September, which could lead to higher inventories and exert downward pressure on prices. Additionally, Russian oil exports to India are expected to rise, despite U.S. efforts to curtail such trade through increased tariffs. This divergence in international oil trade policies could influence global supply dynamics and pricing. Traders are also considering the seasonal shift in demand as the U.S. Labor Day weekend approaches, typically signaling the end of the peak summer driving season and a transition to lower demand for gasoline.
The recent minting of 450 million United States dollar coin, USDC, by the USDC Treasury has highlighted the growing importance and demand for stablecoins within the cryptocurrency ecosystem. Managed by the Sender Consortium, co-founded by Circle and Coinbase, USDC is a stablecoin pegged 1-to-1 to the US dollar and backed by fully reserved assets. This large-scale minting event reflects a robust appetite for stable, dollar-pegged assets, driven by increased demand from traders and institutions seeking to hedge against market volatility, facilitate transactions, and engage in decentralized finance DeFi protocols. The growth of the DeFi ecosystem and significant institutional inflows further contribute to this demand. The stablecoin market cap has now surpassed $280 billion, marking a significant milestone in the digital asset landscape. This expansion underlines the vital role stablecoins play in bridging traditional finance with the volatile crypto market by offering stability, speed, and cost-effectiveness, particularly appealing for global payments. The surge in stablecoins also enhances market liquidity, enabling larger trades without significant price fluctuations and attracting more institutional investors. However, this rapid growth invites increased regulatory scrutiny, as stablecoins are viewed as potential systemic risks if not properly regulated. Stricter compliance requirements may emerge, and concerns about centralization and the need for transparent audits to ensure full backing by reserves remain critical challenges. As the stablecoin sector continues to mature, balancing innovation with robust regulatory frameworks will be essential for sustainable growth, especially as central bank digital currencies, CBDCs, and other technological advancements develop. The transparency and reliability of stablecoins like USDC will be crucial for their widespread adoption and the ongoing sophistication of the stablecoin market.